All right, we're live and in studio today we have Mike McCormick and financial advisor. Mike, of course, many years of financial expert, regular guest on programs like this one, small business owner, McCormick Financial Advisors. And we'll put a link to Mike in the description below so that you can find him. He's a Yale graduate, father of two girls, family of runners, coaches, kids, and he, of course, is a fiduciary, which means he has to put his clients first above his own ambitions. Does that about cover it, Mike?
I think you did a great job, Tom. It's a real pleasure to be here. Thank you so much.
Yeah. Well, I got to tell you, our topic today, I want to know why is the stock market going nuts? And I had to make a list, Mike. We got this Afghan thing. We got a chip shortage in cars and computers. We've got hurricanes and floods. We've got the southern border. We've got all these mask mandates at school board meetings all over the world. We've got the job growth numbers weren't as good as they hoped they would be. And we've got restaurants and things reducing their hours or closing certain days because they can't find people to work, but yet there's hiring signs everywhere. Any one of those things should have dropped the Dow 1,000 points. What the hell is going on?
Well, Tom, I think all those reasons that you mentioned, yes, they're all headline news. They all have the capacity to really impair our economy, and more importantly, they have the capacity to impair our desire to own stocks and to take risk. And there's easy answers to this and there's complicated answers to this. We'll start with the easy answer. Don't fight the Fed has been the mantra since the Great Recession. The Federal Reserve has had easy monetary policy ever since late in 2008, and they've been an active participant in the economy in new ways that they haven't been before, where they are providing demand for stocks, specifically bonds, not directly for stocks, but they're providing support and liquidity through bond purchases, through low interest rate environments, and other policies that they do that has the effect of increasing demand for these assets. And I think we can even put homes in there as well. And so what we're seeing is a very simple economic relationship between supply and demand. When you have an excess demand, you have prices going up. And that is really the simple story right there. Despite all of this bad news that's out there, despite things that worry people more than they ever have been worried. I mean, let's be clear. People are on edge. Well, it seems that does not relate to asset prices. And fundamentally, people have extra money these days. That's partially about this labor problem. We can go deep into that one, but right now we have more people that want to spend money than people want to make money. There's more spenders than workers. In our town of Bozeman, restaurants sometimes are closed midweek or on weekends because they can't provide service. I went out to lunch and I asked to sit out on the patio, and she said, "I'm sorry, we're full on the patio." I said, "Well, I can see two tables that are open right there. Are they reserved?" She said, "No, we just don't have enough staff to serve the whole patio right now." I went somewhere else because I wanted to get lunch with a friend. So why is the stock market going nuts? It's just unfortunately so simplistic. People are willing to overpay for things. They're willing to overpay for cars. They're willing to overpay for safety. Buying a CD right now for no return, that's overpaying for it. And people are willing to overpay for stocks as well.
Yeah. Well, we're seeing that in housing too here. The housing market here in Bozeman has shot up just remarkably. I mean, the average, the median, not the average, the median home, which is the middle, in Bozeman is 700 and some $1,000. I mean, come on, that's pretty pricey.
It is. And it's not healthy for a community because we're not Aspen. We're not Jackson Hole. We're not Malibu. It's a nice place. It's where I choose to be. And we do have a lot of recreational benefit. And maybe unlike those places I just mentioned, we have room to grow. Those places have tapped out on growth. And so for a land investor or a real estate investor or a developer, they can see opportunity here that they might not see in these other mature markets. And they say, well, if somebody's willing to pay this in Jackson, maybe they'll pay this in Bozeman. I think that bubbles will persist. Bubbles are part of it. And so we will have a pullback or a crash or maybe even a new term for that. But I don't think it's yet, Tom, because there's such a backlog of demand right now. There still is such an excess of liquidity, and all those fear triggers that you mentioned, the jobs report number coming out tomorrow, all those sorts of things. It's kind of like bad news encourages the Fed to keep providing this support. And so if we see a bad jobs number coming out, I bet you that we see the stock market reach new highs.
Yeah. Well, that's what I'm thinking is, we've talked for years, the years that we've been on the air together, we've talked about, is the market overvalued, or is it, are we, you were just talking about people are willing to overpay for this, overpay for that. And, we've thought for a long time that we're sitting on this big bubble that's going to burst sooner or later. But, you would think the Afghan thing would do it. The inflation would have done it. You would think we'd see a 1,500 point drop from some of these things. But, when you put them all together.
But let's identify a few different things, right?
Yeah.
Afghanistan is not going to move our economy.
No.
So it can be of concern because of people's concern about foreign policy or where we're going or whatever. But if you're concerned about your money because of people dying in Afghanistan, you're not gonna make wise investment decisions.
Well, we don't have a lot of investment there, unless you're drug running.
It's a third world country. I mean, if all of the money we had invested in there, or anybody has invested there, went away, I don't think it would even show up on anybody's statements. Not to be crass about.
There are some minerals there. There's a little oil there, not a lot, but there's some. So, but
I mean, there's opium.
You're right. Yeah,
there's opium, and I'm not an investor in opium. But now the next one you mentioned was natural disasters, and New York City. Oh my gosh!
Yeah,
right?
I know.
It reminds me of some sort of B grade movie that I saw a while ago, where there was a tidal wave or something.
Yeah.
So we're seeing hurricanes, we're seeing forest fires. What's interesting? So I've been following this about why isn't insurers like Berkshire Hathaway as a major insurance arms, of course, through Geico. Why aren't we seeing them taking more of a hit? And I think that the answer is that the insurance business continually reprices their risk. They're able to raise their rates. And so they're locked in for, maybe a 3-year lookout. And this includes reinsurance, which is the wholesale backstop behind all of your homeowners and liability policies. They have a shorter term window on this. And so, they maybe are underperforming now, but next time they're able to reprice, we're going to see our expenses increase to cover all of the natural disasters that are happening and likely to happen, which is an unfortunate burden on us. Now, you did mention inflation, and that's something that can move the needle, because when $1 is not worth $1 anymore.
Yeah.
and let me tell you this, $1 million these days is worth what $500,000 was yesterday.
Yeah.
You can read the inflation numbers that the government prints, whatever. People have extra money, and inflation is real, which is why we have to stay invested in risky assets. That's why my clients still own a lot of stocks right now, even though we're reaching new highs. And let's be clear, new highs are good. The stock market over time goes up. Yes. 3/4 of all years are positive for the stock market. 2/3 of every month is positive for the stock market. New highs shouldn't even be headline news, really. It's normal. The new lows are the headline news. But you need to have that something to grow Even at your age, Tom, your Roth, I hope, is still invested in stocks because,
Yeah.
tomorrow's going to be more expensive and you're going to need more money.
Yeah. Well, I just talked to my guy yesterday. I'm up 30%. So I'm not unhappy, man. I'm feeling pretty good.
Well, and now you're walking a line, right? And so, the question says, should we take some risk off the table? That's the professional term. And over time, they say, yes, you should take risk off the table because as your window shrinks, we only have two ways to manage risk. We have diversification, which means owning real estate, owning different kinds of stocks, owning some bonds, having cash, having good income, having low debt, all those sorts of things. And then we have time, because over time, any one of those things will do well. But if you pick the wrong time segment, as it happens as you get closer to retirement, you need to have buffers. And right now, with the way interest rates are so low, bonds have been a scary place to be for about 5 years now. And I think it's sort of one of those, what the movie The Blob, right? A slow motion train wreck kind of happening. It's going to, like everything, it goes really slow until it goes really fast.
Yeah, that's the thing. Yeah. Yeah. I feel that serious investors, and you have some as clients, I'm sure, that are really they are really playing the long run, so to speak, with a lot of money, and they've got to be nervous with what they're seeing these days. But it just amazes me that, as I mentioned earlier, the market seemed to react so violently to the smallest news story. And now we've got all these things going on at once, the COVID and the inflation and the Afghan and the hurricanes and the whole 9 yards. The hurricane, Home Depot goes up and insurance stocks go down. So, but it's just been amazing to watch this, and we've watched it for years. We've studied the market for I've done it for close to 50 years, but
but you and I have been on maybe 15 years on radio, and now live on video. And it really, again, it's not as complicated as we want it to be. People have extra money. The government has been an integral part of that. The USA, you put me on this one, tallest midget in the room expression.
Right, yeah.
Because as bad as things may seem here, I don't know anybody moving out of our country to go move somewhere else.
Where there's a better opportunity or anything. Yeah.
Never have I known anybody to move because of economic reasons out of the USA.
Well, you only have to look at the southern border that everybody says, hey, this is the land of milk and honey,
Last year we were worried that maybe we were seeing a turn of the tide going towards Chinese supremacy. Mm-hmm. And that trend on the big time frame may still be intact, but currently emerging markets are not attracting the dollar. The way that the Socialist Republic of China is handling public investments from outside is not encouraging people to put money there. And so we need to have faith that the US of A is still the right place to be. And maybe, unfortunately, the reason why we're doing so well despite global problems is that we're the tallest midget in the room.
Yeah. Well, I think that's true. As we've said all the time, and Shane says from time to time, that money is chicken. It runs where it's safe. And the other thing I wanted to mention, bringing up Shane, who's my partner and is having some computer issues. So he'll be back with us soon, I hope. But one of the things he's been concerned about, and we've been talking about it on our radio show on Saturday, is that we're having a hard time. The Fed's having a hard time unloading the debt. They're putting a lot of bonds up, a lot of debt up, but it's not being bought up. So is that a red flag that's gonna come back and bite us down the road?
Well, Shane is very good at the technical aspects of things in terms of, what's happening under the hood. And I dare say that he may even have a better read on it than me.
Yeah.
What we're talking about, what I deal with, is the retail investor. I deal with a human individual experience in these sorts of things. And when you look at the human real experience of it, we're looking at what is a treasury bond actually trading at and how has it been trading. And what we're seeing is that actually people are still buying our treasury bonds. And if they weren't, we would see interest rates going up and we'd see bonds going down at our level, at our retail level. Your bond portfolios would have downward pressure on them. And maybe we're seeing the beginning of that trend happening. But I just put up a chart right here that shows what the long-term treasury bonds are trading at. And we are, maybe a little bit hot, but not anything that shows a problem. And that's because when you have too much money, when you're worried about something going wrong, you're going to end up owning treasuries. So their auction rates, the participations have been anemic, but secondary markets seem to be picking that up just fine. And the markets are still functioning. Now we're talking about tapering. We're talking the last Fed meeting, the Jackson Hole meeting that was not in Jackson Hole. It was virtual, where everybody is just still digesting the tea leaves of Federal Chairman Jay Powell. Turned out that he's okay. We're warming up to the idea of tapering our bond purchases. And what that means is, like I was saying, the Fed is actively participating in buying things that are putting money in people's pockets, encouraging them to buy stocks. They're going to slow that down. Well, they're going to slow that down by 20%, which will still be a huge amount of liquidity going into the market. Well, there might be an adjustment. One day it could be like, oh, today's the day that we adjust to this new normal. And so it'll be a sharp downturn in that regard. But the best thing you can do for the past 10, 12 years now, anytime the stock market goes down, you should buy more on a dip. And when does that stop? I'm not going to get the memo. Just don't buy it with money that you need back in the next, ideally 10 years. But here's the thing is if you're going to, the day you retire isn't the day that you need all your money. It better not be.
Yeah, that's true. I'll attest to that.
Right. Right?
Yeah, absolutely right.
So the technicals, whether you're looking at the Baltic dry goods prices or you're looking at the auction participations, there's a lot of tea leaves out there. The honest truth is that it doesn't matter if you've been picking tech companies or if you've been picking growth companies or if you've been picking small cap companies. They've all been fantastic. There are very few stock picking wizards right now. The hedge funds are continuing to not outperform because it's simply you're either putting your money at risk or you're not. And if you're putting it at risk in real estate, there's very few stocks out there that just haven't done well. And we're seeing some of these pandemic stocks. We should, move into some pandemic company and short-term plays at your direction there. Certainly there's people that are losing money out there, getting over their ski tips, as some people say. I always say that's a silly expression because when you're in danger on your skis, you actually want to lean forward. Your brakes are in the front of your edges. It's the back seat that you don't want to be in on skis.
Yeah, right. Yeah, it's I don't know that we've solved anything here today, Mike.
Well, I want to put people at ease, and you asked, are my clients nervous?
Yeah,
they're not, and that's because they've got a good financial advisor. And because they've been continually looking at their statements going up, because that's the human nature, is that the recent experience is what stings us, is what sticks in our head. And right now, the big Great Recession is kind of getting to be a long time in the rearview mirror. Of course, like I said, it's been straight up since then. Yeah. And before the pandemic hit, Tom, before it hit, we were talking about valuations too high. And right now, we are.
We were talking about a 40,000 stock market before the COVID came along.
Right. And right now we're seeing PE ratios that are off the charts. I'm writing in my newsletter right now that the PE ratio, now this is the price to earnings ratio, and it's It's a good metric. Of course, like every statistic, it's got its own, pluses and minuses, and we can make it look however we want it to look because we're salespeople, right?
Yeah.
But if you take the value of all the stocks in the S&P 500, which is most of the U.S. market, and you divide it by all the earnings of those companies, because that's what you're buying when you invest in a company, whether it's the local lawn business or whether it's Procter and Gamble or Zoom Video, is that you want to buy the earnings, future earnings. When you look at the price to earnings ratio, typically it's traded, well, depends on where you are, but 15 to 20. And because they're both dollars, the price divided by the earnings in dollars, the dollar sign goes away. Sorry to bring math into this. But this is just a long-term metric to say, are things above average in cost? Or are they below average in cost? Because you want to buy down here and you want to sell up here. And you do that for a long period of time and everything is going to be honky-dory. Well, right now, our PE ratio that maybe, you could say at 20 is an expensive time. We're at 35. We're at 35, Tom. We're almost double what people would consider an expensive stock market.
Yeah, I was going to say 15 is about where it was for years, isn't it? Somewhere in that neighborhood, 15 to 18, something like that.
Yeah, exactly. And so, what you got to do is we're lumping together companies that trade at different multiples is the term. Now, we can back off here because it's really, you as a small business owner know that when you're selling a business, which everybody hopes to do once they build, it sells on a term called a multiple of earnings. And so if your company makes $1 million a year and it trades at a 3 multiple in the industry that you're in, say a dry cleaner or like I said, a lawn business, somebody might be willing to pay you 3 years worth of income on that company. That's a 3 multiple. Well, in the public markets, we're working, like you said, up to 15 to 20 times.
Yeah.
And that's because it's packaged in a way that the average investor can own it. There's a lot more money available there's a lot more customers to sell it to. Whereas buying a lawn business, that's one person's got to buy it and they got to do due diligence and they got to talk to the customers. You can just buy a share of Pepsi and boom, you're an owner of Pepsi. And so the multiples that it trades at are a lot higher. So, okay, multiples. We're dealing with multiples of earnings for valuing a company. And right now I'm telling you, they're really expensive. There's no reason why they can't stay expensive. There's no reason until there's a better alternative for your money. Maybe we're going to stay at this. Maybe now everybody's willing to pay too much for a long period of time. This is just because the way it used to be. Now, the worst words in investing are "this time is different."
Yeah.
Let's be clear about that. Right. Yeah. This time is not different.
We've said that too many times over the past years, haven't we?
We have. And this time is not different. We will revert back to a normal multiple, but this can happen in a couple ways. Of course, prices can go down, but also earnings can go up. Companies can be more valuable. And on top of it, like I said, if the USA is that much better off than everybody else, if COVID keeps other countries on their heels, well, U.S. stocks might be more valuable and people might be willing to pay higher multiples. So, yeah, I'm coming up with stories to justify why my clients are still invested heavily in the market. Even though this valuation, Tom, we've only seen it twice before. The dot-com bust and right before the Great Recession.
Right. Yeah. And since we seem to have a recession every 10 years, we're overdue.
Oh boy, are we overdue
for another one. So that's what a lot of people are nervous about is, are we in a small boat headed toward Niagara Falls or whatever?
I think that the next, here's just, my prediction. Well, we can put it down and Shane would be a great one because he always likes to call me on these things. And then we can get breakfast bets that we never need to pay.
Yeah, right.
Because he doesn't come down here for breakfast.
He can't cross the border. He's in Canada. Yeah.
He's in Canada. I think that we're going to keep pumping this bubble up. And so it's so huge that the burst is really catastrophic. And then I think that we're going to quickly build back to a normal level. It's going to shake out all the people that unfortunately, it's going to shake out all the people that can't afford to hang on. Right. It's going to be a tricky lesson for people that have undersaved, late to get in, over leveraged, don't have a good support system in there to keep them from selling.
Yeah.
But right now, banks have extra money. Rich people have extra money. People that aren't rich have extra money, but they're using it to buy $80,000 Escalades. Bad choice. Naughty.
Yeah.
And some people are paying too much for housing because they think that they need it. And we can take a moment and talk about housing right now. There's some very interesting things happening. Mortgage rates have been low for so long that affordability, that the price appreciation for the same dollar has gone up, right?
Yeah.
And now we're seeing that personal net worths are going up because they own things that are going up, like stocks and real estate. And so they're encouraged to buy more real estate. So thus the bubble. But I'm really fascinated by the Airbnb phenomenon. In our town, which is a desirable place to be, there's a lot of people that are now able to they might have had a rental that might have been renting for $2,000 a month to a bunch of college kids. They can go in there and clean it out or not. And now they can rent it out for $4,000 a month by renting it out to 4 different parties on Airbnb, thus justifying a purchase price for the property that could be twice as much.
Yeah.
And
you're right. Well, and particularly, we mentioned earlier, when you talk about a median price of $700,000, you're probably only, in spite of the fact that, interest or the loan rates are 2 to 3%, and you're only going to pay on a house like that, you're probably only going to pay the realtor a couple percent. You're not going to pay 6% on a $700,000 home.
Oh, yes, you will.
You think so?
Oh, yes, you will.
You think so?
It's a hot market, Tom. If you want in,
yeah.
If you want in, you got to play ball. There's no negotiating. You're not saying, well,
I guess that's true. I guess you are up against people that are going to pay anything to be, if they want the house bad enough, they're going to pay whatever it is. But yeah,
they're looking to park money in something that they think will have long-term value.
Yeah.
Which I get.
Yeah.
But this Airbnb phenomenon is doing damage to communities because the kids that used to rent the place for $2,000 that used to work at the restaurant can't do that anymore.
Yeah.
And so you own a restaurant, or let's say you own the commercial property where the restaurant's located. The restaurant's making less money because they can't be open. How frustrating would that be? You finally get your restaurant working. Mm-hmm. You're finally able to make things meet, and you got an expensive downtown lease. And now you're making not as much as you can, and you still got to pay the lease. So you're going to negotiate with the commercial property owner, and it's going to just lead to a cycle of the only people that can be here are wealthy people, and we're all going to be grumpy because nobody wants to serve us.
Yeah, no, you're going to be right. Well, the college kids are coming back to town. It'll be interesting to see how many of these jobs are filled. Because they are paying, they're paying over $15 an hour for menial labor. So
$20 an hour to wash dishes, Tom.
Yeah, I know.
Sometimes with tips.
Yeah.
And they can't, that's what they got to pay.
Yeah.
And so that's where inflation comes in. Excuse me for dancing around.
That's all right.
Inflation happens when you've got people have extra money, too much demand, prices go up, supply chains get constricted. Is it transitory? That is, of course, the debate out there. If it's not transitory, the Fed needs to be tapering quicker, raising rates quicker. Now, we saw lumber prices spike and then come down. They're still more expensive than they were, so there's inflation that happened.
Yeah.
But that's an interesting one to watch because that is the transitory feature that we were told to expect. Will we see it with vehicles? Because at some point, this chip shortage thing that I honestly don't understand, they can build an entire car, no problem, but there's one little micro thing that apparently is keeping it from being sold. I'm sure there's a lot of smart people out there, but it sounds pretty stupid to me.
Yeah. Well, we can't make them here at the price they have to make them for, I guess. I don't know. They're all made, in China or Korea or somewhere.
Right. So we're going to fix that, right? Some smart people are making new chip photocopy machines that are going to be in the U.S.
Yeah.
And the cost of a chip is probably 50 cents by the time you get the whole thing done.
Yeah.
So, at some point in time, we're going to have too many chips, and we'll have cars put out there, and we'll have competition, and people will have choices between, a fancy new electric car, or they'll be trying to sell you an old school car. There's going to be a lot of good deals on cars. Don't buy a car now. That seems very obvious to me. Unless you,
it's in flux right now as to which direction we're going to go. There's downsides on both. The pollution of a car, a fossil fuel car, and then the other one on what you have to do to the planet to get the stuff to make a battery. It's not, and how do you dispose of that eventually is an issue. So it's there's good and bad on both sides.
There is, and with regard to the SRI, the socially responsible investing trend, I will say that I'm well versed in it, and by well versed I mean I have an environmental studies degree from Yale School of Forestry back in the day, so I'm that's the land of the green, right?
Right.
From there, I worked for an oil company for 5 years and have some balance in my life. The reality is that people care a lot, and perception's reality. And so they like to make money on their stocks. They like to write checks to the Sierra Club or wherever. They like to recycle, which has a very marginal impact on anything. But perception's reality. And so we'll see legislation that'll influence car manufacturing, car purchases in California. But in rural places like we live, you're going to have the opportunity to buy combustion engine cars so long as you don't want the fancy F-350 loaded, chipped out thing that are going to be pretty darn affordable.
Yeah, I would agree with that. I it depends on where you are in the country as to what's going on.
Right. And the car companies are going to be able to be profitable all the way through.
They will.
Right.
Sure. All right, Mike, thanks so much for being with me. It's always fun to chat about this stuff. Whether people understand it or not is another story, but that's why we're here. We're trying to help you along with how this thing all works.
Yep.
Even if you're not in stocks and bonds, you got a 401k, you may have a retirement plan, you may have an IRA. All those things are affected by what we're talking about. So obviously, we hope that we've given you some info and some good stuff to think about. And if you like what we're doing here, hey, don't forget to subscribe, like us, ring the notification bell. You'll
press that one. Press that like button.
Press that like button too, and comment. Leave us a comment. What would you like for us to discuss, market wise or investment wise or business wise or anything like that, because we'll be happy to entertain those questions. So, all right, Mikey, thanks much, man. I appreciate it.
I appreciate you, Tom. What you're doing is a great thing. And to all the listeners, the most important thing is to just be comfortable with your money. It's just money. It's a tool. And when you need help, your accountant is maybe the first place to go. Your financial advisor might be next.
Yeah.
And if we can help, we're here for you. Thank you.
Yeah, those two folks. Yeah, your accountant. Hey, well, they're worth their weight in gold. And Mikey, of course, too. It's making money sometimes not a problem, but what to do with it? Well, that's the question. So that's why we're here. So, all right, that's going to wrap it up for us. So we'll see you on the next podcast. Thanks for listening.